Sure. Many thanks for the introduction, and many thanks for hosting us here. I wish I could be with you in Santiago right now. So indeed, I work in the Monetary and Capital Markets Department of the IMF. So in terms of how climate change has progressively been included within the IMF's mandate, something important to recall, I think, is that in 2021, the board of the International Monetary Fund adopted a climate change strategy. So since then, we've considerably stepped up our climate work in many areas, including in an expansion of coverage, for instance, in Article 4 consultation, and also in financial sector assessment reports. And we've also significantly increased climate-related capacity development. And to deliver these outputs, to be able to do so, country teams in the IMF, they need to be supported with expertise that is basically at the conjunction of macroeconomics and climate science, but also analytical tools, data, and guidance. So basically on these grounds, something that we do underline a lot is that the overarching objective of the IMF's engagement on climate is to provide high quality, granular, and especially tailored, I would say, advice to the membership of the IMF on macroeconomic and financial policy challenges that are related to climate change. So we have this direct country engagement through Article 4 consultations, for instance, when it comes to surveillance. So every 3 years, we're able to allow covering adaptation and resilience for these countries that are most vulnerable to climate change, and also every 5 to 6 years, for all members when it comes to transition risk management. In addition to direct policy advice and I would say surveillance as part of Article 4 consultations, exposure to climate risk and policy options also to manage climate risk has become an integral part of all the analyses we're underperforming now with financial sector assessment programs, so the stress test. So basically that helps us understand better the potential pressure points for the financial system from the physical climate shocks, but also from the transition to a low carbon economy. And this bilateral surveillance tool that allows the IMF to better, let's say, inform policies that are needed to enhance risk management and the resilience of the financial system. So we actually published, I think it was a year ago, a staff climate note that actually shows how we are concretely embedding, let's say, climate change into financial sector assessment programs. And I would totally advise you to go take a look at that, because I think what's interesting, and that relates a bit to your last question, but is that the time horizon for the EPSAP, for the financial sector assessment programs, is 3 to 5 years. So it's a much shorter time horizon than most stress tests that have been, most climate scenario analysis, I should say, that have been currently performed by central banks all over the world. This is due to the typical time horizon that we have for EPSAPs, and we have to apply the same one for climate change. So that's really, I think, an interesting exercise, because when it comes to physical risks, also transition risks, we applied, for instance, for the UK EPSAP, a Minsky moment approach to stress testing, and so that makes the results, I think, all the more interesting, but also the methodologies that we are sort of tailoring to this special time horizon. Also something in which we apply climate in our work, and that's related to financial stability as well, but that's obviously the IMF supported programs. So within the fund's lending mandate, basically, financing may be provided under IMF supported programs when climate-related measures, they are deemed, let's say, critical to solve the country's balance of payment issue. So, sorry about that, I'm a bit sick today. So basically, the IMF is already providing rapid assistance to countries that are hit by natural disasters. We have facilities for that, the rapid financing instrument and the rapid credit facility, but also we've incorporated climate-related elements in fiscal sustainability programs. So anything related to subsidy reform, to carbon pricing, to financial resilience building, for instance, is now incorporated into programs, and we have capacity development for that. Obviously, we also do multilateral surveillance, so usually that's kind of the tip of the iceberg that you see from the IMF is the flagship reports, like the Global Financial Stability Report and the regional surveillance reports, policy papers, etc. So perhaps to take more, let's say, to be a bit more specific on your first question, when it comes to, for instance, the conclusions from the Global Financial Stability Report, I think something important to note here is that it's been 3 years in a row that, our Global Financial Stability Report, we have a climate dedicated chapter. And something that we do emphasize, first of all, is that not only are climate-related risks per se, so the physical risks stemming from climate change and transition risks, source of financial stability risk, but the gap in climate financing, climate change mitigation and adaptation financing is a risk to financial stability. And so this is building on this conclusion and on the analysis that we do to support that conclusion that we do a lot of efforts to scale up private climate finance, especially in emerging markets, developing economies. And so the latest chapter that we published in the Global Financial Stability Report about a couple months ago actually shows that and says that there are policy solutions to scale up private climate finance in emerging markets, developing economies related to structural issues to cope with macro financial and political risk issues, for instance. But there are also climate-related policies that are needed to be able to support that scaling up of private climate finance in emerging markets and developing economies. And so we do elaborate a lot on financial regulation and supervision, on the need for a sound and robust climate information architecture. We also do a lot of work when it comes to, let's say, the need to share the risk of investment, of climate investment in emerging markets, developing economies. And so there, we're doing a lot of work in the context of the operationalization of a new a new lending program of the IMF that is dedicated to climate change, that is called the Resilience and Sustainability Facility. And so there, we do support countries not only in solving potential balance of payment issues that would let's say, stem from climate change, but also implementing reforms, fiscal reforms, structural reforms, sectoral reforms, but also financial regulation and supervision reforms to be able to cope with climate change and to be able to scale up the private climate finance that needs to come for this purpose. So this is basically how in the recent years we've worked in incorporating climate change into our work in a nutshell. I would be happy to answer the other two questions a bit later, but I don't want to take up the whole floor, the whole time, so I'll let my colleagues honestly give their impressions as well. Thank you.
That's great, Charlotte. Thank you very much. Actually, Chile is one of those countries that benefited from your views and insights on our FSAP and exercises on transition risk and also on messages in our Article 4. So Marcus, your turn now. You may want to share your view and also the role that maybe NGFS is playing, not only in terms of disclosure, but trying to address this global topic.
Right. So thank you, and thanks so much for inviting me here today. I would also have loved to been here. I just took over a house, otherwise I would have come, but I think the schedule was a bit too pressed at the moment. But thanks for the invitation. Right, so first I'll say something about the NGFS and how I see its role, and then secondly I'll talk a bit broader about scenarios and I think some of the gaps that we see there and where I would think that central banks should dedicate their intellectual attention to in the years to come. But first to the NGFS. So of course the NGFS has been hugely important in disseminating information about climate-related risks to the economy and to the financial system. I think the NGFS has also been important in clarifying that work on climate-related risks is key to central banks' mandates. It's clearly within the mandates. It's important that central banks understand this, that financial and supervisory authorities understand that, and just spreading the competences in this regard. I think many of us now are thinking about what is the central? So like the NGFS has grown up now, but then the question is, what will the NGFS be as an adult? So what is the role of the NGFS going to be in the years to come? For disclosures, there are a lot of parallel standards being developed right now. So where does the NGFS disclosure frameworks for central banks fit in with what the IFRS is doing with the sustainability disclosures there, how it fits in with the European regulation and disclosures, these types of things. Private institutions are also developing scenarios now. Where do these scenarios fit in with the NGFS scenarios? I think that's some of the discussions that we will see in the years to come, so some of the questions that have to be settled. So that was my first remarks on the NGFS. But obviously, very important collaboration. I think it's also important that we see more international participation in the NGFS, by the way. It has, to a large extent, been a European-led initiative. Other central banks have made important contributions also, but I think there is a disproportionate representation of Europeans there. So I hope that also the Latin American and the Caribbean region will be happy to continue with efforts there. Then I want to say something on scenarios, because I would say, like, we are developing scenarios at the Danish Central Bank, the NGFS is developing scenarios, the IMF is developing scenarios, we just heard that from Charlotte. I'm not always so convinced with these scenarios that different institutions are developing. And I think there are some problems with many of the scenarios. And I think this is a key concern when quantifying the climate-related risks, and also when thinking about this question about the temporal dimension and perhaps the temporal mismatch when doing monetary policy. Because, and my point is, I'm not always so sure that it's the structural transformation in itself that climate change or that the energy transition causes. I'm not so sure it's the structural transformation in itself that's the key loss, that's the key risk from climate change, from the transition. It's more about an increased lack of resilience. And I'll give some examples on this. So, as you know, in particular in Europe, last year energy markets underwent a lot of stress, underwent a lot of change due to Russia's invasion of Ukraine. The decision of Europe to rely on Russian natural gas rather than domestically produced coal, that was a decision made out of climate concerns. Initially, this was a cheap decision to make because Russia supplied a lot of stable, cheap natural gas. But then, once this geopolitical shock, Russia's invasion of Ukraine hit the globe, or hit Europe, then the decision to rely on Russian natural gas became quite expensive. So this is an example of climate-related decisions, the shift away from coal to gas, colliding with a geopolitical shock, and then the interaction between these two shocks has some very big effects, but like the transition in itself, so the climate shock itself does not have an effect. Other examples of this is climate change causing migration, causing geopolitical risk. Again, climate change in itself might not be so economically important, but it causes some other things to happen that then have some economic effects. Or, as a third example, on average, looked over a year, solar and wind energy are cheap and reliable energy sources. But if you're looking at it from a day-to-day or from an hour-to-hour perspective, there are some real issues with resilience, with security of supply from solar and from wind energy. So we might see larger price swings at the short term, at a high frequency, while we have looked at it at an annual average, resilience from oil and gas. From solar and wind. These are some of the things that central banks need to understand. So what do these short-term price swings mean for inflation? What does it mean for your inflation expectations? Is it going to be more difficult to anchor inflation expectations in the future? This is something that we'll have to consider more. And again, the point is that some of the risks, they might have like a climate cause originally, but then it will come in the form of a weather shock, or it will come in the form of a geopolitical shock, it will come in the form of a migration shock. But looking back at the origin, then there might be some climate-related issues that cause this to begin with. So I still don't think we have come very far in the modeling of climate-related risks. And I hope that central banks and researchers will be able to dedicate their intellectual attention in this way in the years to come.
Thank you, Marcus. So you see forthcoming many changes and improvements in terms of scenario analysis. You raised very interesting topics. The different taxonomies that impact disclosure. What's one of the issues I guess we're going to discuss here as well. The evolution of the tools, right? So the traditional tools that we have to measure financial risks need to still improve. And you raised this issue on geopolitical tensions and that may affect scenarios. I think to touch upon many of those topics that we have discussed in the previous sessions of this conference on the relevance on energy supply and migration. Thank you, Marcos. Let me now move to Daniel to hear your perspective from Banco España. I saw that you have made a great progress, and maybe you can tell us a little bit about this new report that puts together all the analysis of the macroprudential authorities, and I think that's going to be a good benchmark for many countries. Daniel.
Yeah, thank you very much for the invitation. It's a great pleasure to be here with you in this amazing conference. I learned many things. Thank you once again. The second thing is that I'm from DG Economics in the Bank of Spain, and then, these are my views. They are not the financial stability views, but this is my understanding of what is on the financial stability front. But apologies from my colleagues on financial stability if not, if they don't share my proper views. Yeah, let me talk a bit about this report. No, the ANSTENFI is the new macroprudential authority in Spain. It was set up in 2019, and then mainly it adds the roles of the three regulators and supervisors of the financial sector, namely the Bank of Spain, the National Securities Market Commission, and the DG of Insurance and Pension Funds. And then, the law that rules this, the climate transition and the policies has forced to this entity to publish a biannual report on the climate change risk for the financial sector. No? This report has been published recently, this summer, and there has been a collaborative work of these three supervisory authorities. No? And then the role of this report is just to try to have a common framework to establish what are the risks that the financial sector is facing. No? And then the structure is quite straightforward in the sense that first they talk about transition risks, and mainly this considering a common scenario for all the financial sector that is mainly a disorderly transition scenario in which carbon prices are going to increase abruptly, and another scenarios on physical risk. The problem of the scenarios of physical risk is that they are not going to be comprehensive and not going to be harmonized. No? And then this first scenario on transition, it has some impact on market valuations, and on top of that, there's some impact on the solvency of the banks. No? And then the report has found what has been the impact on the investment fund portfolios, in the pension funds, and also in the insurance companies. No? And in the banking sector, takes into account two factors. No? One of them is what's going to be the implication of the drop in market valuation of these more polluting firms that will be affected by this disorderly transition scenario, and also the effects on the solvency via the great expositions. No? On the physical risk, the report recognized that this that this analysis is in an early stage of development, and that there are a lot of limitations in the data. There is not much historical information. I will talk a bit later on this. No. And then they recognize that the analysis on physical risk has been very limited. It has to be improved in the next report that is going to be published in 2 years. In this edition, there is only covering two topics. No? What is the impact of the drugs and the heat waves via labor productivity in the banking system? And the second phenomenon is what could be different water shocks affected to the capital of the insurers. I think that the report really is a very good first step, to compile and just to share methodologies and to share knowledge about among the three regulators in the financial system. I hope that in the next editions, the analysis, especially on the fiscal risk, will improve a lot. Related with the last point, I would like to stress what are a bit the limitations that assessing the climate risk has in comparison with other risks. No, I think in the second question that you were doing, was again that the financial institutions could see financial risk could see climate risk as a traditional financial risk. Mm-hmm. And to some extent, it's yes, no? Because it's going to be mainly located with credit and market exposures to other sectors. No? This will going to be the traditional credit risk channel, the market risk, or liquidity risk. No? And then, that we can say that it is more or less the same framework. But there are some features that make it very much different. No? Especially that we don't have enough data to assess properly these risks, and also the quality of this data is very limited at this stage, and the techniques of analysis are to some extent very much different. No? Let me elaborate a bit on this point. On the first point, we need high granularity information. No? Because this risks vary very much between industries, between sectors, between firms, even between households, no? Even among geographical localizations, no? Even between companies could be very much different because the technologies that you are using are very much different, no? And they may be facing different transition risks, no? Or even between households in the same municipality could be also quite different, because some of them could be located their houses close to riverbanks or the coastal beaches, and others not. No? And then we need a really granular data, as on this conference has been amazing, the developments that has been in this front. No? On the other hand, mainly the assessment of the climate risk has been the assessment of financial risk has been in many cases backward-looking, but we need much more forward-looking analysis, no? Because with the past, we cannot estimate what is going on, no? As previously. No? We need now just to incorporate that we don't have much information, neither on physical risk nor in transition risk, because some of them has not happened yet. Even that we need longer time series to estimate that. Even that they happen, the duration is very short for doing this kind of analysis. No? And also we need to estimate the spillovers between sectors, the interlinkages, and between the real and financial sectors. No? And another thing that is very much different with the previous approach is that here for instance, the transition policies are designed to make the households and firms to react and to buy inputs or to buy goods that are less polluting. No? And these kind of things we have to consider that the economic agents will react to the transition policies, and it will imply, that this consideration has to be dynamic. Meaning in comparison with this some static consideration of the risks. And also we are facing, that is very much related with the points I was talking before, we are facing enormous uncertainty. We might face possible tipping points, and then in these conditions, I think it's really difficult to estimate some kind of probability of default or loss given default or whatever. No? And I think my impression is that the best tools that, from the financial perspective, we can have to assess this financial climate risk is doing some kind of sensitivity analysis or top-down stress test. No? That is a methodology that we can use to have an idea what could be the climate risk. And then the issue of the stress test is the tool that we have been using in the Bank of Spain to assess the climate risk, either the transition risk or the physical risk. And the point here is that it's very needed to clarify which are the assumptions that we are taking, and to clarify that maybe this is just an illustration of what could happen, but not to overestimate the power of the stress test.
You raised very interesting topics. I was suspecting somebody would raise the issue on data gaps and the granularity of the data that we need. So Mauricio, you have a great challenge now to bring this to the local scenario. I guess that most of the topics that we have discussing here on coordination of authorities are things that we have been discussing previously in Chile as well. So as former vice president of the CMF, or currently as an academic that I'm sure will follow on interests in sustainability, what's your view? What are the lessons that you learn about this topic?
Yes, thank you, Rosario, for having me in this panel, and thanks to the audience members for sticking until the end. And also thanks to the rest of the panelists. So, how to quantify the effects of climate risk on financial stability? It's a hard question. There are many challenges. But in my experience as a board member of the Financial Market Commission of Chile, I can think of at least two challenges. So the first is related to information, data, transparency, disclosure. So at the very least, if you want to quantify the effects of climate risk on financial stability, you have to understand as a regulator what is the exposure of the different financial institutions, banks, insurance companies, etc., to climate risk. And exactly how are they mitigating, how are they managing that climate risk? So that's the very basic. It's a necessary but not sufficient condition to try to quantify these climate risks. And disclosing information about climate risk, it's tough. It's not like when a company discloses its sales or its cost. Disclosing exposures, scenarios to climate risk, it's much more challenging. And moreover, there's more than one international disclosure standard, which makes it very difficult for investors and regulators to compare the exposure of different financial institutions to these type of risks. So what we did at the Financial Market Commission, by the way, Rosario was also a board member of that same institution some time ago, is we published a regulation in which we require firms in the real sector and also financial institutions to disclose their exposure to climate risk and more general to sustainability risks, and to explain how they manage those type of risks. And in order to make that disclosure comparable across institutions, we ask them to do it according to TCFD, which is the standard disclosure, international disclosure standard for this type of matters. So that's one challenge, information disclosure, and that's one practical way in which we at the Financial Commission at that time tried to address that challenge. And then the second challenge, which Daniel mentioned it as well, is you have to model climate risk, but it's very different than the way you model credit risk and the way you estimate the default probability or the loss given default, because for the standard risks of financial institutions, credit risk, market risk, operational risk, you use historical data. That's the standard way to do it. We've always done it that way. But you cannot do that for climate risk. First, because you have limited data, and also because climate risk is a moving target. So how can you expect to use information from the past to try to predict what's going to happen in the future if everything is changing? So that's a big challenge. So the models have to include, as Daniel was saying, some type of forward-looking component, and that's something difficult to do. What I'm trying to do, Rosario, right now is a research project with some people at the CMF to try to understand how different climate shocks affect the credit risk of firms. So we compiled a very nice data set on different types of climate shocks. Heat waves, floods, wildfires, 10 different types of climate shocks at the very granular level, at the county month level. And then we cross this with the data or the credit registry data that we have at the Financial Market Commission, which tells you exactly where's the location of the firm, and you know how much debt the firm has with all the banking sector and whether the debt is in default or not. So then we ask the question of whether what happens when a firm is located in a geographical area that suffers a big negative climate shock. Does it have more difficulties in paying the debt to the bank it owes? So the idea basically is to try to calibrate the elasticity of credit risk to these different types of climate shocks, to try to advance on this idea of modeling climate risk, and therefore finally trying to quantify the effects of climate risk on financial stability.
Very interesting. Looking forward to that. I guess that we have made some progress, the Chilean authorities, regarding first measures of impact of physical risk, first measures of transition risk. In the morning, somebody commented about the process that the bank has been doing in terms of providing statistics and on carbon emission. That will definitely be a source of information for research. But we also saw today at some of the sessions that the information provided by companies in their filings to securities regulators can also be a good source of information for research. So we'll wait to see what kind of disclosure the companies provide to the CMF and see what they say about management of climate risk and also ecosystem degradation. That is something that we haven't touched upon so far. So in this second round, I would like to ask you if you want to touch upon more frontier issues that you're working. I know, Charlotte, that you've been working on some technical notes that I think they were released today. Want to tell us a little bit about that?
Yes, so I can touch upon that. Sorry, I had to turn off my camera. I'm sick, so I was coughing like super hard. So, I mean, first I wanted to say that I totally agree with all the points that have been made, and especially on data gaps. I mean, this is an issue that we are working very extensively at the IMF, both on the technical side, working on aggregating actually climate-related monetary and financial statistics, and also on the policy side, we are supporting lots of countries in the in the, let's say, design of their alignment methodologies. For instance, when it comes to transition taxonomies, transition planning frameworks, but also data collection related to that. So this is a great area of work, and in the NGFS, we actually had co-chaired a work stream on bridging data gaps in 2021, 2022, and some of the conclusions that we had made as part of the final report that I believe was published in July 2022, we actually are trying to implement them as much as possible. So I totally agree with the points that have been made there, and I think, it's not like we have to reach perfection anyway. I think the challenge here is to be able, as it was said, to assess the exposure and to be able to understand a lot of the other, let's say, effects stemming from physical and transition risk there. But when it comes to climate risk analysis, and this has been raised as well, I mean, obviously there are lots of challenges that are related to the variety of scenarios to reflect the high degree of uncertainty, also the, let's say, the difficulty to predict some of the physical and transition risk drivers, the fact that they are intertwined, also compounded risks, I think, is receiving more and more attention in the NGFS, in the Financial Stability Board, in the IMF, and in every central bank, that is working in that area. Something that we're looking at in the FSB, for instance, in the Financial Stability Board, I co-chair one of their work streams on climate data and vulnerabilities. It's the second round effects and the interlinkages as well across financial institutions. I think that this is something that has not received a lot of attention so far, but considering the interdependencies across, within, I should say, the financial system, this is something that is receiving more and more attention. And this is in parallel, obviously, to all the work that has been told today on data availability and on modeling interlinkages as well. Actually, when it comes to the IMF's work, so indeed we published actually today what we call a staff climate note. It's like one of the, let's say, publications of the IMF when it comes to climate change. And we published a staff climate note that is directly related actually to scenario design. The exact title is Geoeconomic Fragmentation and Energy Transition, Implications for Climate Scenario Design. And so this staff climate note that you can find on the IMF website, the motivation stems from a very simple fact, is that right after the start of Russia's invasion of Ukraine, and the whole weaponization that Marcus talked about, actually, of energy supply, that led to that renewed prioritization of energy security and rising geopolitical tensions. And so right at this moment, in February, March, let's say 2022, we started thinking, on the implications of geoeconomic fragmentation and the pace and the rate, I should say, also of the energy transition for climate scenario design. And so basically we started thinking that, given the, let's say, the long-term nature of the energy transition, what would be the structural implications of this so-called polycrisis for energy and climate policies, and how should the design of scenarios for climate risk assessment actually accommodate this new reality. And so on this basis, we have published this note that basically on the first hand, let's say, makes a diagnosis on the impact of the polycrisis on the global transition to a low-carbon economy. We look into carbon lock-in, the fact that even though we've seen a formidable, let's say, increase in renewable energy investment, there is still a lot of investment in fossil fuel capacity, including new fossil fuel capacity, especially in emerging markets and developing economies. We see that that generates an amount of carbon lock-in in response to that energy crisis. This has political economy consequences. And that's actually quite consistent with the fact that globally energies have that symbiotic relationship with each other. And so we are doing and have published already some work on the likelihood of oil and gas, analyzing, the likelihood of oil and gas to actually being able to transition to low carbon activities. Is it a decarbonization of oil and gas operations, or is it a diversification of their activity? So in our diagnosis, we talk about that. We talk about the prospects for renewable energy as well. Obviously, in this note, I should have said that from the very outset, but we take, let's say, the tail scenario, right? We're not forecasting. I mean, obviously, there's a slight difference between the two, but we're really thinking when you're doing risk management, you should think about, some of the worst case scenarios, basically. And the disorderly transition scenarios, we believe they could even go further to adapt to this new reality. And the reason why I'm making this parenthesis is that in our diagnosis, for instance, when it comes to the prospects for renewable energy, we are really looking into the likelihood of that continuous cost reduction of low carbon versus carbon intensive energy. And we see that this likelihood is decreasing. We see that low carbon technologies that could be affected more heavily by the current high rate environment and higher for longer rate environment than carbon intensive energies, for instance. So we are doing not only this node, but also more generally in our work at the IMF, quite a lot of analysis on this front. And in our diagnosis, we also look at the policy responses to geoeconomic fragmentation and macroeconomic shocks. So monetary policy reactions, but also fiscal policy reactions to high public debt and fiscal deficits. And we say that basically all these more frequent global shocks, they may lead to structurally lower global growth. And so this is on this basis that we do, in the second part of our note, look at, let's say, underline preliminary suggestions to accommodate that new reality. So we make a lot of recommendations related to the scenario implications of the consequences of this poly-crisis. We're not doing the work ourselves, even though some of this work we are, but we believe that this should be a collective work to be done, obviously. We believe that some of the recommendations that we're making, they're totally feasible in the near term from a technical perspective. Some of them would require more work, but we really believe that there are scenario implications from the disorderly transition, carbon lock-in, the prospects for renewable energy, and the geoeconomic fragmentation and macroeconomic shocks. And so we make a series of recommendations in that note to accommodate for that. And obviously, we are totally on board as well to totally, let's say, implement some of that in our own climate risk analysis. This is actually totally in line with a note that was published last fall, so in 2022, in November, I believe, by the Financial Stability Board and the NGFS on climate scenario analysis. I think the Banco Central de Chile has actually participated to the survey, if I'm not mistaken, of central banks that elaborated upon climate scenario analysis, challenges, the opportunities, the need for comparability, the tailoring of climate scenarios to the current reality, etc. And so the IMF is totally willing and obviously doing so already, but to cooperate much more also on these grounds. And I think this is in line, if I'm not mistaken, if I understood correctly, Marcus, with some of the points that Marcus made at the very beginning.
Absolutely.
I'll stop here. Sorry, I put up hours on that. I think this is a fascinating topic that we're touching upon together.
So I guess it's also very late where Marcus is located, so maybe you can bring us some ideas from the future. You may have a few hours ahead, right?
Right. So I actually, so what Charles said, I think it's on point to what I'm saying, that we need to look at the interactions between different risk channels. So what I'm hoping that where we'll be in a few years is that we have a more integrated approach, so that we have climate, and then we have nature-related losses, geoeconomic fragmentation, effects of, demographic change, and then all the other risk channels that we are used to looking at, have them in an integrated approach. Because, reality is integrated, so we also need to look at these risks integrated. I'm not sure it's so fruitful to single out the climate-related risks as as a standalone source of risk. These things interact with each other. I think perhaps touching a bit on that also, there are some discussions about whether we should change capital requirements, risk weighting, to better factor in climate-related risks. From the perspective of the Danish National Bank, we cannot rule out that this might be a good way to do, but we are not so far convinced that there's actually a need for this, because again, climate-related risks is just one other source of credit loss. It's just one other source of market risks. It's just one other source of operational risk. So perhaps it's better to have like a general risk-based framework than to again begin making too many ad hoc adjustments here and there. But of course, if you have a certain risk type where you thought it was not material historically, but it may be material in the future, then there may be a case for adjusting something. Again, I would be worrisome about singling climate-related risks too much out, for instance, as compared with geopolitical risk.
You raised an interesting topic, and I guess that that kind of tools would definitely change the incentives for banks to internalize those risks, right? But let's start with disclosure for so far. Thank you, Marcus.
Sure. I mean, if you begin to, if you want banks to internalize the risk, or which you of course want to do, that's just risk management. But just remember, from the perspective of the Danish Central Bank, I would say it should be risk-based still. So we should not adjust over and above what we can justify on risk-based grounds. And then if you want to like actively support the green transition, then there are government investment funds, there are government subsidies, carbon taxation, that we have these instruments for doing that, fiscal tools. We don't need financial regulation or monetary policy to do that.
Absolutely, but interaction with the private sector is still quite relevant, right? Even to create awareness. Thank you, Marcus. We have a few minutes left. And I would ask Danielle if you can tell us a little bit about ecosystem degradation, biodiversity. It's also on the topics of the conference, and so far I think we haven't touched upon that. So if you can briefly refer if you have doing something like that in Spain.
Yes, sure. I found also the point of Marcus very interesting, no? Because I think that the financial stability has some kind of trade-off. No, on the one hand, they need to, they have to ensure that the banks recognize the climate-related risk, no? But on the other hand, the transition process requires that a lot of funds will be directed towards the transition, no? That means a lot of investment, and then the financial sector has to help to channel these funds, no? And then to some extent, that it generates some kind of frictions within the mandate, no? Because on the one hand, it needs to recognize this risk, but on the other hand, it needs to try to allocate the funds, or try to encourage the banks to allocate the funds towards the green transition. So, I have the impression, as well as with the monetary policy, that the financial stability policy has to promote, the objective of the governments, no? But it's not an instrument per se. They have to go and try just to go for the primary goal of recognizing these risks, no? But but on the other hand, that these kind of measures just to try to change the risk weight, or to try to to make a different incentives to go for green activities could pose significant risks, no? For that. Even I'm thinking, for these activities that currently are brown, but are going to transition to green, no? What are you going to do with that? Will you classify as brown? Will you classify that they're going to be green? You need to follow these things. I think that this is really interesting. In the monetary policy front, we have some kind of the same of tensions, no? Because also the government is trying to use or try that the monetary policy collaborates in the objective, no? But we have another goals, and sometimes it's not so easy. I think that we should recognize that the mitigation and adaptation policies is mainly the task of the governments, no? And then financial supervisors, financial regulation, and monetary policy, the only thing they can do is only help, no? But they are the ones that first are elected democratically. We are not. They have the tools, and they know what are going to be the consequences of these policies, for instance, in terms of the inequality and other kind of distributional aspects. And I think that governments should take their part, take the lead in all these policies. And thinking twice, I don't know what's the role of the monetary policy or the financial sector policy. on top of helping. No? Yeah, on the ecological degradation, I would like to talk a bit about the what has been a bit the strategy to analyze the climate risk in the Bank of Spain, no? And then at the very beginning, we started to analyzing the transition risk because we were thinking they were the ones that are going to materialize first, no? And then we have to put the resources, and then let's go for the transition risk. But we were discovering, at least in the case of Spain, that physical risk, especially the acute risk, are materializing much faster than expected. And then now we are trying to better understand what could be the impact of drought, heat waves, of floods, wildfires, aridity on the credit, and also on the collateral. And we are setting up some kind of a research agenda to understand what are the implications for the financial sector and from the macroeconomy of the physical risk. Sorry. But one thing that I think is not so common for a central bank is also we are doing some preliminary analysis of what could be the effect of the ecological degradations over the economic and financial variables, no? Especially in this case, it's going to be through the collateral channel. And then the idea is pretty simple, no? In Spain, we have the largest salt lagoon in Europe that is called Mar Menor. This is in the south of Spain, southeast of Spain, that is in a region called Murcia, that is very quite touristic. And then this lagoon, this lake, has been facing a process of ecological degradation. The process is called eutrophication, no? And mainly is because in the lake there are going, given the agricultural use of the surrounding area, there are going a lot of nutrients, and then the alga is growing very much in the lake. But then at some point it means that the alga were so dense that they were not letting the rest of the life living there. And then the dead matter began to decompose, and then there is a process in feces that have enough oxygen, especially when the temperatures are relatively high, and then you see in the place that you have your house, you see that really you are surrounded by a lot of dead fish. No? And then the question is, if this process of ecological degradation has an impact on house prices of this area in comparison to an area that is pretty close, that is the southern part of Alicante, no? It's very far away. No? And then with the process of diff in diff, the issues we try to analyze since this phenomena started, what it was in 2015, if the value of the houses has changed in a statistical different way between the two areas, no? This Mar Menor and the south part of Alicante. And then Lamas, that is the paper, and Gabriel Perquiros found is that that it really had an impact, this ecological degradation, no? And the prices of the houses in the Mar Menor has been 45% lower than the prices in the south of Alicante, no? And then, the prices has grown 45% less than in the south of Alicante, no? And then it implies that the people really, with some lacks, discover, that they don't want to have their vacation there, and they don't want to go there. And then this process has some kind of impact on economic variables. But house prices also are the collateral of the loans in this area, no? And also has some kind of financial stability implications. And it's quite interesting because also, the amount of the mortgages that the banks are providing in this area is also around 40% lower than the amount of the mortgages that is provided in the control area. No? Meaning that banks have also incorporated, that these developments in their decision taking. No? And then in this way, we found a way just to think about how ecological degradation will affect financial variables, and to some extent will affect financial stability. Obviously, this is a very little region, and it's not going to affect financial stability in a broad manner. But okay,
it's very interesting what you can do with very granular data.
Yeah.
And it resembles a few cases that I think we could do also in Chile. Mauricio, and you're a very generous guy, so what would you like to do with your 5 minutes?
I would like to
open the floor for questions
yes,
from the
yes,
from the
because
audience.
it's 6:30, so I think
You're very generous.
Yes.
So do we have any questions from the floor? Elias.
Sorry, that's it. Yeah. Thanks for the interesting conversation. So I guess a question for Mauricio, also Rosario, that you've been sitting, you were sitting at some point at the financial regulator in Chile. So indeed, there are some initial steps in terms of disclosure. I'm wondering how you see the next steps in terms of first disclosing the double materiality, because if I understand the way the disclosure works right now, is that it's really disclosure on the exposure of the self-declared exposure of firms on different risks that may arise, but not on the impacts that they have on climate, or on not even going broader to the broader environmental issues, just on climate. And second, which I think is the more important step, when or how do you see this process flowing into actual pricing in terms of charging higher APRs to firms that have higher risks? I mean, when do we see the money in this? How do you see this process going in Chile? Thanks.
There's a strong debate, I guess, in the CMF on these topics.
Thank you, Elias. So the issue about double materiality, just as a reminder, is two sides of the same coin. First, how a firm affects the environment, and then the other side of the coin is how the environment affects the firm. And as Elias said, the disclosure regulation in Chile only focuses on one direction of the coin, which is how the environment affects the firm and what does the firm do in order to mitigate, to alleviate, to manage the risk coming from the environment. And why did we do it that way? Because by law, the securities law in Chile has to protect the investors. So the disclosure regulation was thought always for the investors. And the investors have to have the information about how the environment risks are affecting the firms in which they are investing, so the investors can select which firms are more sustainable in the long run. So that's the reason why we only choose one side of the coin of double materiality. And I don't think that's going to change. But it's because, the law is very clear. It's the securities law, 18.045. We have to think about the investor's point of view. So the regulation is done from the investor's point of view. So that's a partial answer to your first point. And then to the second point, there's two angles. One, you said APR, so you're thinking about Basel III additional capital charges.
Yeah, weighted.
Yeah, so I'm not...
As Marcus mentioned.
Yeah, so maybe Marcus can say a little about that. But there is a second dimension, which is in asset prices, something that Johannes early in the morning mentioned, that there's a market incentive here, that if a firm has high exposure to some type of environmental risk, climate risk or biodiversity risk, and it's not really hedging, it's not really mitigating that risk, and it's disclosing that to the market's going to punish that firm in the sense that maybe a pension fund manager is going to reduce the exposure of that company in its loan portfolio, reducing or producing some sell-side pressure, reducing the price of the stock, and therefore increasing the cost of capital. So I've always seen that there's a market mechanism in which this more disclosure provides incentives for firms to undertake more sustainable activities. But that's the way I see it. But maybe Marcus can tell us a little more about the...
I guess we have enough material for a workshop on financial stability implications and climate change, maybe. I think it's quite late here, and it's probably much later where Charlotte and Marcus. So I would like to thank each one of you for joining the panel, to the audience here to staying with us. And just a few conclusions. I guess it's pretty clear that climate change and ecosystem degradations certainly poses challenges for central banks, for financial authorities, for policymakers in general. We have a lot of work to do on understanding and assessing potential impacts and threats to financial stability. We need to refine and develop our tools, our capacities. All tools may not be sufficient. Scenario analysis, stress testing are definitely going to help, but we still face challenges in terms of data gaps, have to face these horizon issues, and I also trust that disclosure statistics are definitely going to be good inputs. International cooperation and coordination among authorities also highlighted as an important topic, and I understand that some of the measures needed to address adaptation mitigations are responsibility of governments, but still I really think that from the point of view of central bank, we can play a relevant role in generating knowledge, generating information that can also help financial institutions and market participants to internalize those risks and to also play a relevant role in mitigation and transition. And finally, I think we do have a role to play in raising awareness. Conferences like this, I really believe that can also help to raise awareness about the risks posed by inaction, and I hope that's some of the messages we can deliver. So based on that, I guess we can close. We can give ourselves an applause, and thanks for joining us.